The BSE index raising out of the gates on April 1st, jumping over 1% or about 76 points to close at 69.79, supported by nearly $500 million in net foreign buying. Joining us now for more in the markets is Gabryle Aguila. He's head of research at Unicapital Securities. Gabryle, good to see you. Hi. Welcome to Market Edge.
Hi, good morning. Nice to be here.
Nice to see you. Gabryle, given the head start we've enjoyed in the first quarter, 7% gain, middle of the pack if you compare us to our Asian peers, how much more upside do you see for the index for the next 3 months? Or could you be expecting the exuberance to mellow down a little bit this time around?
Okay, when we started off the year, we were estimating around 7,200 for the full year of 2024 as our target. Clearly, optimism has spilled over into the first quarter of the year, coming on the last 2 months of 2023, when we started to correct and went into pretty much a nearly 5 month rally now, testing the 7,000 resistance levels. Moving into the second quarter, which brings me to your question, are we feeling any exuberance? It's not necessarily an exuberance, but mostly on a bit of cautiousness or some aversion to potential inflationary risks going into the second quarter. Of course, what we think will bring up the market to a higher upside, which may be beyond our 7,200 target full year, would be better than expected inflation print coming to the second quarter, especially as inflation will enter low basis compared to last year.
All right. So aside from inflation, though, we're also going to start getting first quarter earnings reports from listed companies. They're going to start rolling in the next couple of weeks. What are you expecting to see? And I guess, are there any indicators that you're focusing on when you look at these earnings reports?
Going into 2024, the expectation is a lot brighter compared to what happened last year, but still, we expect it to remain challenged given still elevated inflation. Rate cut prospects are still on the table, but still to be later on this year. What clear indicator we want to see for the first quarter is a good confirmation of revenue growth expectations. In terms of margins, of course, we're staying vigilant over potential inflationary pressures or second round effects, especially coming from the most recent wage hikes to trickle more later into the year. But first of all, for us, we are looking at base demand for revenue growth.
All right. Just very quickly, what are we supposed to be buying or betting on for Q2?
For Q2, well,
without giving away your blind item.
We do like the property sector right now.
Okay.
The property sector has risen over the past 3-4 months on the prospect of lower interest rates later on. The oscillating view on when rate cuts will be has tempered the rally compared to the other more undervalued stocks we're looking at. But still optimism on as rate cuts will happen, whether it be the end of the year or the first quarter or second quarter of next year, it will happen. And current valuations are showing a decent amount of upside.
All right.
We're also looking into consumer manufacturing. Certain stocks have been quite discounted given the sustained inflationary view. And it's good for accumulation at this point.
You did talk about inflation. We are getting inflation figures this Friday. ANC will carry that live. But so far, the BSP is trying to set the tone already, maybe set the bar of expectations. They're saying we're either going to stay at 3.4%, where February numbers landed, or even higher, 4.2. So we might see an uptick. There's a very big chance of an uptick. And if we do see that uptick, are you expecting any sell-off in stocks, or you think it's already been priced in?
I think right now, what's being priced in for inflationary expectations is around the consensus of 3.7 to 3.8%.
Really, just higher. All right.
The latest estimates by the BSP is released up to a potential 4.2%. Currently, if we realize a 3.8%, that would just bring our year-to-date average at 3.3%. But any higher above the government target of 4 would be what would concern investors, especially as, again, we enter the second quarter with a lower base and, of course, some inflationary pressures coming from the summer months and electricity and energy prices.
All right. And, of course, yesterday, big news, the World Bank actually kept their GDP forecast for the Philippines 2024 at 5.8, while lowering the rest of East Asia and Pacific. While they did keep our 2024 growth stable at 5.8, they did raise 2025 forecast to 5.9%. Do you think with these forecasts, we do deserve 7,200 level? What level does the PSEI index deserve? With this kind of expectation that we're going to be the fastest still in the region and we got a bump up in our growth forecast?
Well, last year we also were one of the top performers, but we did see the re-rating come later into the year. Moving into a 2024 target, I think it's still being cautious of potential downside risks for economic growth. But the 2025, of course, with a more certain rate cut view coming in, we do deserve the 5.9% upgrade for the GDP next year. What we think will happen going into the third quarter with positive economic outlooks would really be a valuation re-rating more than a bigger expectation on the acceleration of GDP and corporate growth. Currently, we're just around 12 times 12-month forward PE. We came off a low of 10.6 last year. Moving into better skies or bluer skies, we may see a re-rating up to 13 or 13.5. And that's where we think the PSE could outperform our current 7,200 level.
All right. I just wanted to bring in our 10 minutes into trade for the day. The PSEI is back above 7,000. Index is up 0.75%, 49 points. We're at 70.28. Everybody's in the green, led by the services sub-index up by 1.3%. Gabryle, I think we're ready for your blind item. Talk to us about the stock that you're monitoring closely and that you like. Don't tell us, just describe and leave your viewers to guess what this is. What do you have for us today?
Okay, the stock we have right now, fresh off stellar multi-year performances from its mining subsidiary, the conglomerate brings a deep war chest and approaches 2024 with growth in mind, allocating substantially higher capex for full year 2024. Likewise, some M&A prospects have bolstered investor sentiment and on the potential longer-term outlook if realized. That optimism has kept the stock above current full-year price targets in our view, but it may well warrant a ratings upgrade once potential catalysts further materialize, as most current and potential developments are still currently being priced in.
What sort of upside are you expecting in the next 12 months?
Of course, right now, as we said, it's quite beyond already the target price that we've set at the start of the year. I think around negative 1.4% if we're to look at it on a cold basis. But we are saying again, you may see a ratings upgrade later on.
All right. Just have to be patient. On that note, Gabryle, thank you so much for joining us. A pleasure speaking with you. See you soon.
All right. Thank you.